Welcome back, everyone. So Palantir's highly anticipated May 4th earnings are right around the corner. And honestly, if you've been watching the ticker lately, you know the tension is it's real. The stock is seeing some serious volatility and a lot of downward pressure. So today, we're cracking open a very specific pre-earnings playbook built exactly for this kind of setup.
It really boils down to this one crucial question. How do you safely trade a highly volatile tech stock just days before earnings, right? Instead of just throwing a dart and guessing which way the market's going to react after the call, we're going to use this explainer to break down a highly calculated option strategy, one that actually takes all that market fear and uses it to our advantage.
Section 1. The Earnings Volatility Trap. Let's look at the pre-earnings pressure. Okay, let's look at the timeline we're dealing with. As of April 29th, the stock is already taking a bit of a hit. It's down roughly 4%, trading right around $135.60. Earnings are our main catalyst event, just days away on May 4th. And then there's May 15th. That is our target options expiration date. And keep that date in the back of your mind, because it's going to be absolutely crucial in just a minute.
Now, with earnings this close, implied volatility is sky high. The market is actively pricing in a major move. But what does that actually mean for us? Well, look, we know Palantir historically beats expectations, right? But this elevated volatility tells us traders are bracing for some serious turbulence in either direction.
Section 2. PLTR Technical Setup. Finding Support and Resistance.
Since we know the market is jittery, let's check the chart data to map out our danger zones, and more importantly, our safety nets. On one side, we've got this solid flat floor of support sitting right between $128 and $135. That's our safety net right now. But if there's even a hint of softening commercial margins in this upcoming report, we could be looking at a harsh drop right through that floor, bringing us down to a retest level in the 115 to 120 zone. And why is a breakdown a real concern right now? Well, Palantir has actually been printing lower highs on the chart since February. When you pair those lower highs with that flat support floor, you get what's called a descending triangle pattern. In technical analysis, this specific setup often acts as a warning sign before a breakdown, if that support fails. And that is exactly why we need to trade this smart, rather than just blindly buying shares and hoping for a post-earnings pop.
Section 3. The Cash-Secured Put. A conservative play.
All right, so we know the technical risks. Let's flip the script and look at the solution for protecting our capital. Enter the cash-secured put. By using a cash-secured put, we're basically stepping into the shoes of an insurance company. It's a conservative, high-probability way to generate income. We are literally capitalizing on the elevated implied volatility, the fear, baked into the market right before earnings. We are letting other traders pay us for their panic. Let's lay out the exact blueprint for this trade. We are going to sell to open a cash-secured put. Remember that May 15th expiration date? That's our target, giving this trade a nice, short 16-day window to play out. And here's the key. We are going with a very conservative strike price of $115. For doing this, the estimated premium you'd collect is about $1.60 per share.
Now, since one options contract equals 100 shares, that translates to a clean $160 of estimated premium. And you collect that cash right up front. It goes straight into your pocket today. But the catch is, you do have to put up the collateral to buy those 100 shares at your $115 strike. So you're looking at setting aside exactly $11,500 per contract as collateral.
Section 4, Risk and Reward Breakdown, Building Protection. Let's get to the most crucial part. Why this specific trade structure acts like a shield for your portfolio. Why does the $115 strike make so much sense right now? Well, it comes down to three things: establishing a deep safety margin, securing a really attractive yield, and setting up a statistical risk-to-reward ratio that heavily favors you. Let's talk about that safety margin for a second. By going all the way down to a $115 strike, you're building in a massive 15% cushion below the current $135.60 stock price. Remember that $128 primary support floor we talked about earlier, the one we were worried might break? Well, $115 is well below that. So even if the post-earnings reaction is incredibly negative, you've got a huge buffer. And then there's the math behind the trade, which is just fantastic. Collecting that $160 on your $11,500 collateral gives you roughly a 1.39% return in just 16 days. If you annualize that, it is a wildly attractive yield. Plus, because you collected that $1.60 premium up front, your actual break-even price drops down to $113.40. So even if Palantir takes a massive nosedive, your break-even point gives you this incredible margin of safety against a catastrophic loss. You're still sitting comfortably above the 52-week low of $97.83.
Finally, let's demystify one last piece of options jargon, the 0.10 delta. What does that actually mean? In plain English, a 0.10 delta tells us there's statistically only about a 10% probability that this option will expire in the money. So flip that around. There's roughly a 90% chance the stock stays above $115, the option expires perfectly worthless, and you just walk away with your $160 premium without ever having to buy a single share of Palantir. Like I said, the odds are heavily in your favor.
Which brings us to our final thought. The market is clearly pricing in a lot of fear right now. But as we've seen, you can actually translate that exact fear into structured, high-probability income. With a massive 15% safety cushion below the stock's current price and the ability to pull in elevated premiums thanks to that high implied volatility, you really have to ask yourself, is outright buying the stock and just hoping for the best the right move here? Or is taking the calculated path of the cash-secured put the smartest way to play Palantir's upcoming earnings? I'll let you be the judge of that. Thanks for joining me on this explainer, and happy analyzing.